Hello, wonderful people. I want to start by saying thank you for all the comments of appreciation. I'm really happy to see that. Today, we'll be going through the summary of Lecture 10, and I've devoted my Sunday to this. I hope you're all having a great weekend. If you enjoy my work and want to support me, I've attached a Buy Me a Coffee link where you can contribute. Don't forget to join the list for the PDF summaries. All the important links are in the description. Let's dive in. Before we dive into the nitty-gritty of price action, let me explain what all these lines represent so you don't get confused. These lines from here to there represent the opening range, which is the high and low formed yesterday between 9:30 and 10 in the morning. On this line, we have two key levels. The third quadrant of the opening range is 20% retracement of the weekly candle. In the middle, we have the midpoint of opening range and then first quadrant. Now, this orange line below represents the 30% retracement of the weekly candle. It's important to note that this level is fresh, meaning the price hasn't reached it yet. In this lecture, ICT focuses on some advanced concepts and nuances in price action that are critical for understanding market behavior and improving trade execution. Don't get confused between the opening range gap, and the new day's opening gap. The opening range refers to the first 30 minutes of price action after the true open at 9:30 a.m. To identify the opening range gap, toggle between electronic trading hours and regular trading hours. The gap between previous day's close, and the true open is the opening range gap. Remember, the true open starts at 9:30 open. The new day opening gap forms when the market closes at 5 p.m. and reopens an hour later at 6 p.m. during electronic trading hours. I hope this clears up any confusion. If you have any questions about this or our previous lectures, please comment below and I'll reply to you. These levels are critical because they often serve as strong support or resistance points. ICT explains that if the "thank God it's Friday" TGIF pattern has not formed and we've had a strong bullish week, we can anticipate a 20% to 30% retracement of the weekly range on Monday, especially if the TGIF pattern did not play out. ICT emphasizes that if an opening range gap hasn't been filled, he usually carries it over on his chart for up to 3 days. These gaps are significant because they often attract price, providing opportunities for trade setups. As the session progresses, ICT highlights how price interacts with the opening range high. In this case, price first treats the opening range high as resistance and then later as support. Additionally, the 20% TGF level provided support twice, showcasing its significance in price delivery. A fair value gap, FVG, is also observed, where the price trades into it and then falls, leaving an open FVG above. ICT stresses that he wants this gap to remain open and watches for price to potentially target the liquidity resting below relative equal lows. ICT then delves into the concept of one-way price delivery with minimal retracement. He advises that in such scenarios, it's essential to identify relative equal lows or swing lows, as the price is likely to target at these levels during the lunch macro period from 11:30 a.m. to 1:30 p.m. This 2-hour window often sees retracements which can provide trade opportunities. As price action unfolds, ICT notes that the price went on to close today's gap to the tick before retracing slightly and breaking through the new day opening gap, NDOG. New day's opening gap. ICT expects this gap to be left open, setting the stage for an institutional order flow entry drill. ICT observes that, contrary to his initial expectations, price comes back and closes the gap. This results in a failure swing, meaning the recent swing could not surpass the previous one, creating relative equal highs. At the same time, the price takes out relative equal lows, but does not manage to clear the relative equal highs. ICT advises that whenever you have an entry idea, you should assess how many handles price points are available. He emphasizes that the range should offer at least 20 handles, allowing for a target of 10 to 12 handles. The discussion then shifts to an extended FVG, where within this gap, there is another FVG. The price retraces into this new bearish FVG, forming a bearish order block. ICT explains that the bearish order block is the candle with the highest high, and when the next candle opens, it touches the lower wick of that high candle and then drops. This scenario could have provided multiple take-profit opportunities in just a 2-minute run. ICT emphasizes the importance of understanding the context of price movements by looking at historical price action. For instance, if price reacts from a particular area, there is likely something on the left side of the chart, like a BSE, that caused this reaction. Take a look at all this price action. We started with an area of consolidation, followed by a series of back and forth price swings. The price moved up and pulled back 4 times to reach this fair value gap. This is what ICT refers to as a high resistance liquidity run, where it becomes very difficult for the price to break through. However, it doesn't mean that a breakthrough will never happen. We must always be prepared for anything in the markets. Understanding this concept helps us form a narrative. If it's tough for the price to move lower, we should consider whether there are clean areas above. In this case, with these relative equal highs, we should give more weight to the idea that the price might rise to take out those levels before it starts to fall. He explains that if the price breaks above a FVG, it could reclaim that gap and target relative equal highs. ICT also mentions that when price moves into a fair value gap and does not close below the 50% level, it suggests that the price is meandering around a level without a clear direction. If this happens, traders should avoid entering trades until the price either breaks below the FVG or shows clear signs of continuation. ICT also explains that markets do not always behave in a predictable or consistent manner. There will be days when but there will also be days when the market moves erratically, making it difficult to find good setups. On such days, it's essential to remain disciplined and avoid forcing trades. He advises his son and beginners to use FVGs as an entry model. While it might not always offer the best entries, it is the easiest to spot and is reliable when combined with understanding liquidity draw targets. For instance, buying 1 tick above the high of a discount FVG or selling short 1 tick below the low of a premium FVG can provide consistent opportunities. ICT concludes by discussing the current market environment. He notes that the day's price action was very fickle, with small back and forth ranges. He reiterates that traders should recognize that the market does not always behave in the same way. Some days will be more challenging, with less clarity, while others will present clear and profitable setups. The key is to remain patient, disciplined, and always align your trades with the underlying market conditions. ICT also reminds traders to document their observations, noting the time and how the price behaves at certain levels. This practice is crucial for developing a deeper understanding of market behavior and improving trade execution over time. If you haven't already subscribed, please do so, and give this video a thumbs up. Don't forget to check the description for all the important links. I'll be back with Lecture 11 soon. Stay tuned.